Two main regimes are expansion and recession. The good news is most of the time capitalism works and the economy is expanding. But if you have reason to believe the US economy is at risk of a recession, then you de-risk portfolio, go defensive.
There are four regimes under which you would make a tactical decision. The expansion regime, which is the regime that we are mostly in, but you also have a shock regime, a systemic issue regime, and a contraction regime. Under what kind of circumstances would you switch from an expansion regime? Have you done so in the past, and why?
Two main regimes are expansion and recession. The good news is most of the time capitalism works and the economy is expanding. But if you have reason to believe the US economy is at risk of a recession, then you de-risk portfolio, go defensive. The key, and that's a philosophy I adopted very early on in the early 1990s, is the S&P 500 is the best economist. In other words, you're more likely to predict the economy based on the S&P 500 than you're likely to predict the S&P 500 based on economic analysis. That's absolutely key. In other words, we sort of read the tea leaves, The market internals tells you a lot. The other two regimes, external shock, you suffer the drawdown. By definition, when a meteorite hits Earth, you cannot predict this, right? It hits, it has consequences. The key is to assess the market reaction. And in those circumstances, when an external shock triggers a overreaction in the short term by the investor community, you can take advantage to go overweight risk. It's a rather low risk opportunity to go overweight risk and increase your risk load in portfolio. And finally, systemic risk in when there is a fundamental problem in the real economy or in capital markets, and this will transpire in trade markets. This is actually not only predictable but identifiable, and this is an opportunity to reduce risk. That's the case of 2008 with reasonable predictability, reliability.
So the SAA and the TAA kind of work together?
Absolutely, but most of the time you don't do much TAA.
Okay, but how much of your portfolio is a SAA and how much is TAA?
100% of the portfolio follows the SAA, and then you can have a TAA overlay. How much you will deviate from your SAA is a function of your investment horizon, your risk appetite, and tactically, your understanding of the market drivers and reading of the situation.
And how much does this play into the core satellite format that we use here at Julius Baer? What's the appeal of this core satellite, where the core would be your SAA, right?
Yes. Well, the appeal of the core satellite is manifold. Number one, we operate in a highly regulated environment. So in the way and how we can, on a discretionary basis, manage our clients' money is constrained by a variety of suitability, tax aspect that differ across each and every one of our clients. So the discretionary solution that will be suitable for you depends on where you're domiciled, what is your tax regime, and so on.
And what's a discretionary solution?
Well, a discretionary solution is a mandate in which you select a strategy and mandate us to manage the money.
So you don't have to make all the tiny decisions, basically.
Exactly.
Okay.
Exactly. In your advisory portfolio, in that core satellite approach, you can access instruments that are not necessarily available in discretionary mandates. If you enjoy trading, nothing wrong against trading. You can trade a lot, You can experience yourself and see if you actually add value by being more active in portfolio or not.
This is the fun part.
It's the fun part. There's nothing wrong with it. You should just be intellectually honest with yourself and understand if it's entertainment or producing good risk-adjusted returns.
All right. Okay. Well, you said in episode 1 that you really, as a kind of player manager, as a CIO who also is very involved in investing, that you put your money where your mouth is. So if it's not too bold, what does your own portfolio look like at an asset class level?
Well, if you look at my asset allocation, the starting point is I do have a substantial share of my assets in real estate, purely for private use. And therefore, this involves substantial liquidity. And my personal bankable portfolio is primarily liquid and 100% in equities, Swiss and American equities.